Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
And thanks for having me back, Jim.
So in Vancouver, it's plus 7 degrees and sunny. Where you are just outside of Toronto, what have you got?
They're setting up for a minus 30 degree night tonight. Cold weather warning is out for the greater Toronto area.
Man.
I'm on the perimeter.
So March doesn't really mean that much this year.
Well, it'll probably be plus 20 by the weekend, so who knows, right?
Yeah. Well, bundle up. Ross, we were surprised to see real estate boards release their sales stats last Friday, or less than 24 hours after February had ended. Is something like that new, and can they really get their stats together that fast?
Wow, that is a mouthful there. So I think we warned on your show in the fall that some of the bigger real estate boards in Canada were going to be making some major changes as they release their data in 2019. And you're seeing those changes already. Your local listeners out in British Columbia who are looking at the Real Estate Board of Greater Vancouver, that website has been totally redone. They have totally revised their website as of January the 1st. It coincided with the British Columbia Real Estate Association totally revamping their website. The Toronto Real Estate Board totally revamped its definition of sales. Yet the entire public is oblivious to what's going on because mainstream media is underfunded and the press who is reporting on the housing market clearly is not being paid enough money to go out and do the minor amount of research required to rebuff pretty much everything that you're reading. It is impossible, Jim. I stress the word impossible to release housing data within 24 hours of a new month beginning. I hope your listeners can understand what I'm saying. Real estate boards who, for the first time, released brand new housing market data within 12 hours of a new month beginning, for the first time in their history, are clearly sending a new messaging strategy. They're sending a strategy that is designed to divide and conquer. My local real estate board here in Burlington, which is the Hamilton Burlington Real Estate Board, one of the oldest real estate boards in Canada, one of the most respected real estate boards in Canada, they released on Friday. They traditionally were always one of the last real estate boards to release, taking at least one full week before they would ever open their mouth about real estate stats of the previous month. I'm sure all of your listeners who have already watched the Real Estate Board of Greater Vancouver release earlier than they ever have in their history, are wondering why. Were the home sales really as low in February as what the board was saying they were? Are they covering up something? Are they trying to set up so that March is going to look better? They're going to count sales that actually took place in February into March. Is that what's going to happen? And what I would tell your listeners is this. Only now, on the first day, the fourth day of March, are we able, meaning my firm, able to accurately record what happened in January. it takes us a full month to get even a local housing market's MLS data and be able to interpret what sales should go into January's sales mix, which sales will be carried forward into February. It takes a full month of reporting in the following month before you can go back from the previous month and make an honest commentary about it. That's why it's called sales stats and not sales data. People are being commenting about in Vancouver. We'll stick with that this week. Let's stick with that this week, Jim. I'm seeing people come out and say single detached homes are an all-time record low. And they're making these statements 12 hours after the month ended. Well, folks, your MLS reporting rules meant people are still going to have until tomorrow to report sales that actually took place in February. That's right. As we're recording this show, MLS rules and regulations allow February sales in the Real Estate Board of Greater Vancouver to be reported as late as tomorrow. And then those sales are supposed to be counted, because that's when they occurred, in February. You see, you can remove your conditions on the last day of the month, but then each of the 69 real estate boards across Canada has a different reporting guideline. In other words, if you don't report the sale to the board within so many days, you could be subject to a fine. Now, if the listing is interboarded, there is a further delay that has to be taken into account. If it is from a non-board member, it is a different delay again. So anyone who released a single sales stat for Greater Vancouver on Friday is a liar. So I need to be clear on this. They are misleading, lying to the public, because all of the sales from February are still not reported. And you won't know that they're reported until sometime later tomorrow. And then, if a real estate agent makes a mistake, a brokerage makes a mistake, there are still flexibility in the MLS rules that those sales can be reported weeks later. So when you're reporting a single month's sales, you need to look at the sales that took place the month before and the sales that take place the month ahead. And then when you look at all three of those month's sales, you put the ones that belong to the given month, say in this argument, February, back into February's pocket of sales. Right now, we just finished looking at January. Now, but Ross, you say you measure the market, a year, 2 years in advance. Well, that's the beautiful part of knowing how you should read a housing market, because you can take these kind of delays now, be reporting them, and you're still so far ahead of everybody else that it doesn't matter. You give this type of a buffer to your commentary. What your listeners, if they're buying a home, should know about Vancouver is, listen to these numbers, Jim. Just listen to these numbers. Because you're not going to hear this anywhere else except Howe Street today. Sales in February, preliminary sales. So these are sales that we would not even report, are 65% below peak. Not 30, not 39, not what you're reading in the newspapers. They are 65% below peak. Sales were 180% more in February of 2016. You're not going to hear that anywhere. It hasn't been published. Now, after we come on to the show, you can be sure there'll be some blogger, someone out there who's going to have this data point recorded on their websites. But as of today, right now, this data has not been published. I would also tell your listeners, if you're thinking of buying a home in Vancouver, just how bad is the housing market in Vancouver? Well, listen to this. Not over 90% of all the homes listed for sale in the greater Vancouver area during the month of February did not sell. 90%, over 90% of the homes for sale did not sell. Buyers said they were overpriced. Buyers turned up their nose to the condition and the price that was placed on that property for sale. Less than 10% of all the homes offered for sale in February were purchased. Now, compare that back to 2016, February of 2016, for the sake of the argument, when 33% of all the homes that were offered for sale were purchased in February. 33%. Again, we're talking 3-to-1 ratio. What does that mean to a home buyer when 33 out of 100 houses were selling at a market's peak and only 10 out of 100 houses are selling in the market's trough, which isn't there yet, by the way, folks? What it means is, right now, all of the houses, if you looked at every single house that was listed for sale, only the top 10% of homes sold. The best quality is the top 10%. So the worst that any home buyer who purchased a home in February did in that month was they bought the number 10 out of 100 ranked homes. So there was for 100 homes, they bought the very worst buyer, got the 10th best house. Back in 2016, the very worst buyer, unlucky buyer, bought the 33rd worst house, or the 33rd best house, excuse me. The 33rd best house. So you are now getting the 10th best home in 2019 versus the 33rd best home way back in 2016. When you hear a housing market described 24, 48, or the first week into a new month, as a home buyer, you should understand that you cannot trust that information. That information is released on those short windows only to support home sellers. In the same way that all the metrics you read are home seller beneficial, the reason that real estate boards release the first day, 2 days, 3 days, 5 days into a new month is because those numbers, 8 months out of 12, will always favor the home seller. So what you've heard already released, reported in the news, on websites all over about your February housing market, specifically in Vancouver, Fraser Valley, and Calgary, to name a couple, is false. Because they haven't even allowed enough time for all of February sales to get reported. Guess what, guys? Magically, March is going to be a better month than they thought it was going to be.
We'll have more with Ross Kay right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Ross Kay. Ross, a listener is asking if first-time buyers are allowed to take 30-year amortizations. Will that cause a surge in the market to take place?
Oh, you can hear all the realtors out there just licking their lips, hoping that this is going to happen. You can hear all the home builders out there hoping that the crazy days are going to return to the market. You can hear all the bankers out there who just recently experienced declining bank profits, all missing their targets because they don't know how to simply measure mortgage data. They're all thinking this is the magic solution. And what I want to tell your listeners is this. Home prices have already dropped in all major cities outside of Quebec to compensate for a 30-year amortization. And there has been no increase in first-time buyers entering the market. The reduction in home selling prices has already offset the differential that a 30-year amortization would have made. We are seeing historic price destruction across this nation. Across the Greater Toronto area, from Markham to Oakville, it is a devastation of home values. Homes that are regularly hundreds of $1,000s less versus where they were at the peak of 2017. In Vancouver, we have properties that are millions of dollars below what they were selling for at the peak of 2016. Millions. Sure, your condominiums have taken a little bit longer to take the hit, but that hit is still coming. It will not be as dramatic. Since we ourselves don't use percentage change, we use actual dollars, it won't be noticed as much. But what I would ask your listeners to maybe do a little bit of research on themselves if they question what I'm saying about the housing market in general in a correcting market. There is this common myth called house prices are sticky. Economists use it, bloggers use it, housing analysts use it, sticky prices. And they use the reference point of historical house price corrections where they really don't see a huge decrease in price taking place. When in fact, the actual houses, individual houses, are taking mammoth hits in their value. And your listeners can go back to Ontario from the 1990s. The average selling price in the province of Ontario did not even drop 10% in the Great House Price Correction of the 1990s. At the same time, families were losing 40 to 50% of their home's value when they were selling. As we have said on this show over and over again, the average selling price, the benchmark price, the Internet National Bank House Price Index, these are all measures of a housing market's house price change that has nothing to do with the houses they're talking about. It is solely a buyer's metric. Clearly, if a home buyer was qualified to spend $500,000 last year, they are qualified to spend $500,000 this year. But if you're buying in Vancouver, what's different about 2019 versus 2016? You're getting the 10th best house if you're the last buyer to buy in the month versus getting the 33rd best house if you're the last buyer to buy back in 2016. The amortization myth the wand that they're hoping to be created to get this housing market rolling again, get housing prices increasing again, get Canadians into taking on more mortgage debt. Everything that the stakeholders want to rip every single penny of income from home families in this country won't make any difference this time. It's too late. We look at a housing market, as we said on the show before, not as a bubble. We look at them as a wave that turns into a tsunami. After the tsunami has come to shore, after that wave had reached its peak, after it had crashed onto shore and been coming back out, a second wave comes along, and it gives everybody the illusion that things are going to be okay. But by the time the second wave pulls itself back out, you look at the devastation that's left on the beach. Houses destroyed. Families destroyed. This is how a housing market functions. You cannot turn that wave into a tsunami again. The amount of energy that it takes to create a tsunami is like it's just unimaginable, Jim. It leads in the housing market. It's what leads to those great concerns over the indebtedness of your nation. The net wealth of Canadians would not be where it is today if Canadians hadn't taken on all that debt. Now, I would hope everybody looks at this logically and says, well, what happens when that debt is no longer being sustained? Like it isn't right now. Your bank profits, all 6 banks, were all below expectations. So your listeners should ask, why was it here on House Street that the total opposite about what the bank's earnings were going to show was talked about on this show? We have told everyone for over a year that the bank's profits were going to drop because mortgages were dropping. We have said for over 2 years how the gross domestic product of a country that is dominated by home ownership is going to trail the housing market. We're seeing those numbers right now, too. We're seeing everything that we've talked about on this show comes to be true sooner than later. The 30-year amortization myth is not going to return the market. You may hear rumors. You may hear grumblings. You have the stakeholders misrepresenting data to try to create the illusion the market is getting hotter again. What I will tell your listeners is this: the sheer amount of capital required to return that tsunami to where it was before, I do not believe is even a technical possibility with the income levels in Canada today.
Ross, today the Bank of Canada announced mortgage debt had practically stopped growing in January. So is this what's happened?
Yeah, this is exactly what happened, Jim. So we come on this show, and 2 years later, what we say comes true. The housing correction in British Columbia from 2016. We came on this show in 2016, and we told everybody that what you're seeing in the housing market it's already over. Those peak sales, those peak prices paid in 2016, your housing market had already slowed down. That tsunami had already reached shore. All that was happening is the final curl was fooling people right at the very end. They thought the wave was going to keep going. We knew the wave wasn't going. In Toronto, the GTA, we told our members way back in 2016 that the Ontario housing market was over. We measure a housing market in 3 stages. Okay? So that those 3 stages covered 3 months. By the time the 3rd month hits, we still have 2 years before the public was aware of what happened in the housing market. It wasn't really until 2018, 2 years later, where they realized that the housing prices had dropped what they had. So when we hear the Bank of Canada come out and they're announcing mortgage debt, this is the slowest mortgage debt growth since the 1980s or something like that, we're laughing at them. We said on House Street a year and a half ago that that's what was going to happen. So these things are all forecastable. You can forecast every single minute detail attached to a housing market. We also know that the way that they report mortgage debt in Canada, in our opinion, is totally flawed. We never report on mortgage growth. We couldn't care about mortgage growth. We care about mortgage originations because those mortgage originations, the new mortgages that are taken out in a month, can then be cross-checked against our resale housing data, our new home housing data, and, to a certain degree, our investor housing data. All of that data can be cross-referenced against the mortgage debt to see if you're right. How come that chart doesn't appear? How come the Bank of Canada doesn't produce that chart? And we will tell you it's one of the most important charts in economic theory anywhere in the world. Why is that chart not published? I don't know. All I know is, on this show over a year ago, we warned the banks. We warned people investing in the banks that mortgage growth was ending and that the bank's profits, which were based on that growth, were going to drastically be altered. The flip side, Jim, is this. We love struggling banks. The wealthy homeowner loves a struggling bank because a struggling bank will still pay us the dividends that they're committed to. The beautiful thing about Canadian banks, is that the dividends that a bank pays have never gone down. Great recession, housing market correction, everything that's gone on in the last 30 years, dividends have never retreated. The stock price sure does, but the dividend hasn't. Now, we're not experts in the financial markets, so I'm not pretending that. But what I can tell your listeners is this. By using mortgage origination data back in 2009, we would have told our members to buy bank stocks. We would have given them that advice, not because the bank stock was going to increase in value, which it did, and we wouldn't even have told them to buy at the very, very bottom trough of the market. We wait till the market starts going back up, and then we make our call. Because that's when our mortgage origination data verifies whether this call is correct or not. If every homeowner in Canada went out and did that, with the reporting that took place this month by the Canadian banks, for every dollar that you had invested in bank stock in 2009, you would now be receiving a 13% dividend income for every dollar that you invested way back in 2009. You would be getting a 13% return on your money. So when people say that housing has been the best investment over the last 20 years, we would say hogwash. It has allowed people to take their home equity and make it into the best investment that they could, but if they left it in their home, that didn't happen. The people who took their money out of their house in 2009 bought bank stocks and have been collecting dividends on those stocks nonstop for the last 10 years are the winners. Because right now, today, whatever the bank stock has gone up, it's gone up. Let's say the bank stocks have doubled. You bought something at $30 a share, and now it's $60. Okay, $35, $70. Let's say your bank stock has doubled. So what? You're not going to sell it anyways. It's just like your house. you're not going to sell your house. You're not going to sell it till you die. You're not going to sell your bank stocks till you die. What you're going to do is you're going to collect an income every single month until you die. And right now, if you had bought in 2009, you are now collecting 13% annually. 13%. A staggering, life-altering reality. This is what we read when we read Bank of Canada mortgage data. We're looking at something totally different that apparently a world economist looks at.
We'll have more with Ross Kay right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features to our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, a listener, was asking us about calculations like days on the market or selling price to list price ratios, and was asking why they only measure the most recent listing.
Why did they only measure the most recent listing? Okay, great question. So, and I had a discussion with someone else about this actually earlier today. What the public needs to understand is the organized real estate, the MLS system infrastructure, and the brokerage business are all solely and legally responsible for sellers, to get sellers the highest price possible. There are literally decades of case law that have enshrined the rights of home sellers to get the highest price possible. If the real estate board does anything to harm the selling price of a seller, cause them to get a lower selling price, the real estate board has violated their contract with that seller. The real estate brokerage who has that property listed will have violated the contract with that seller. Now, the seller can certainly sue the real estate broker for damages and win. There is yet to be a case where a seller has sued a real estate board. And what is the reason why that hasn't happened is the metrics, Jim, that you cited. Days in the market, by its definition, a definition that has existed for 40 years, means how much of the most recent listing price did the buyer pay for the house. That's what it means. It doesn't mean how overpriced was that property on day one, 6 months ago, how many times the property was reduced over that 6 months, until finally it was reduced low enough that it was at market value, that a buyer looked at it and purchased it. That is not what days on the market means. It is not what it has ever meant. Why the press, why Greg Klump, why economists believe that it is something that it is not, I have no understanding. All I know is it simply means these guys haven't read their own definitions. The definitions that exist in the MLS rules and regulations. Days in the market is a useless metric. It has always been a useless metric. Experienced buyer reps never use it. They tell their clients never to listen to it. If you're looking for days on sale, that is an unbiased metric. That is a metric that tells everybody how many days the house has been for sale before it sells. That means if the property was overpriced for 6 months, the buyer has been told that house has been listed for those 6 months. That metric does not violate MLS rules and regulations. The only problem is that number isn't published by a real estate board. It isn't published by real estate listing brokers. And why would they publish it? The only use for that number, that metric, is to get the lowest price possible for buyers. Now, not only should you know days on sale for a specific property, but you should know days on sale for the total inventory in an MLS system, or in your geographical market, or in your neighborhood that you're looking at buying in. Because if you don't have that number, you don't know where your market is trending. Because remember, days on market doesn't tell you where your market is trending. It only tells you what houses that are the most attractively priced, meaning they sell, have been listed at their final listing stage. You need to have an overview of the whole market. This is the same as your new listings to sales ratio. The new listings to sales ratio is a naturally correlating metric, which is why if you look at the plethora of charts that exist in Canada today, talking about new listings to sales ratios, where they say that generally between 40 and 70% is a balanced market, almost every single real estate market in Canadian history has remained balanced. Only at very minor times in those windows does the market fall out of their definition of balance. That's because it's a correlating metric. If Joe and Shirley want to buy a house, they have to list their own home. When their own home sells, they buy another house. That's a 1-to-1 listing to sale ratio. Yes, the house may have been a new listing the previous month, and there is sale the following month, but there are other families that are doing exactly the same thing. And that's why it's a correlating metric. It isn't causational. You have to look at the overall market. And let me break it down to our listeners this way, Joe. Everybody in Canada was told the average selling price in Canada was up to $500,000. Okay? The public, that is a useless metric for the public. Now, you got to remember, your benchmark price mirrors average selling price. I don't care what anybody tells you. You can go back, graph it, chart it, they match up. Just trust me. You can go do it to double check what I'm saying is true. But what the people don't understand was that 50% of the homes that were purchased in Canada were priced below $375,000 since 2003. 50% of the homes that were purchased were priced below $375,000. The average means nothing. The average to median ratio does actually mean something, but that is a highly complicated metric that takes a tremendous amount of understanding of the sales mix to even explain. But you didn't hear anywhere in Canada that 50% of the homes were being purchased for less than $375,000 last year, or this year for that matter. Yet that is exactly the truth that's going on. People focus on the prime markets. Kitsilano in Vancouver, the Bridle Path in Toronto, and then the perimeter community markets around those neighborhoods, where the most expensive homes in Canada exist. Canadians don't buy the most expensive homes, which is why you have a housing correction. The amount of work, the amount of energy to go into a tsunami that allows the number of houses to sell in Kitsilano or Howe Sound or Point Grey in Vancouver, the Bridle Path, or $1.5 million brand new build in the Newmarket. The size of that tsunami has got to reach a historic proportion. It took a historic amount of energy into that wave to allow those sales to take place the moment before the market crashed. All of the data in every housing market across Canada for the last 40 years has shown this exact same pattern. It's always the same. But when you understand how a wave moves, if you understand the amount of energy involved in a tsunami, it only makes common sense that that is what's going to happen. The reason why we measure mortgage origination data is because we have to know how big the tsunami is. Because there is a theoretical limit to how high a tsunami can reach when it comes to a housing market. And we know the moment that's the energy behind that tsunami starts to slow, it's going to come to shore and it's going to crash. This is how a housing market functions. This is how you protect yourself from buying at the wrong time. This is how you capitalize by selling at the right time. And this is how you time a housing market. There is nothing that I'm saying here today that decades of data doesn't back up. You're not going to see that data if you're looking at days in the market, if you're looking at new listings to sales ratios, if you're looking to selling price to list price ratios, if you're looking at monthly housing stats from a local real estate board. You're never going to see it there because it doesn't exist. Those stats are all designed to get the highest price possible in the shortest period of time.
Ross, thank you so much for chatting with us.
Thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from the wealthyhomeowner.ca. Our popular YouTube channel is Talk Digital Network. Find us on Twitter at Howe Street. If you have any questions for Ross, like the ones we had today, you can send them to info@howestreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of Howe Street Media Incorporated.